Welcome back, everyone. We have a lot to go over in this episode, a lot to get to. First of all, the stock market's having a rough day. Your portfolio is probably going to be in the red, unless, of course, you're 100% invested in Netflix, or Pfizer, or AbbVie, or Broadcom. There's like 4 or 5 companies in the S&P 500 that are in the green today. Now, the Wall Street Journal is blaming this sell-off on the COVID-19 curbs. Investors worry that measures to contain Omicron will weigh on growth and prolong high inflation. So it's kind of a slew of concerns there. There's the COVID-19, the curbs that the government might implement. This might slow down economic growth and cause higher inflation. None of this is good stuff for investors, and I'll be going over all of this in this episode. Now, I also got the chance last Friday to sit down and talk with Ed Petoniak for an hour. This is the CEO of VICI Properties. VICI Properties is one of the biggest holdings in my portfolio. I own over 1,100 shares. Now, I was able to speak to Ed directly and ask him a lot of questions, and these weren't softballs. I asked him direct questions about dilution, about experiential property and convention business during the Omicron spreading. I asked him about inflation and how that affects the term leases. I asked him about every aspect of this business. Why is it undervalued compared to its peers? What are his thoughts on the competition? What are his thoughts on the concentration and the level of risk involved in Vegas with 2 main tenants? And we went through everything together. So I'm going to highlight just a few minutes of this episode, but if you want to see the whole thing, it's on my other YouTube channel, Joseph Carlson After Hours. Now, also in this episode, we're going to be swinging by Capitol Hill and looking at what a couple members of Congress are doing. One of them is Elizabeth Warren. She is the anti-billionaire person. She's really made this her messaging. Elizabeth Warren hates anyone that has a lot of money, and she wants them to pay their fair share. I think that's reasonable. A lot of the requests she wants on the surface are reasonable. But then she does things like this. She's running an ad on Twitter and Facebook that labels Elon Musk as being a, quote, freeloading billionaire. She's literally labeling Elon Musk as a freeloader. So we're going to decide in this episode, who is the freeloader, Elizabeth Warren or Elon Musk? We also have other fun little bits of news coming from Congress. Nancy Pelosi, who is married to a man that's famous for making day trades that kind of line up with privileged information that Congress had prior to the trade being made. Well, she was asked, do you think that members of Congress should be able to trade individual securities? And here's her reply.
Because this is a free market and people, we're a free market economy. They should be able to participate in that.
She says, of course, Congress should be able to trade stocks. Now, I'm going to also share some thoughts on this as well. So get your favorite drink, buckle in, because we got a lot to get to in this episode. Now, if you like this type of long-form content, you can support the channel for free by simply thumbs-upping the video, as well as subscribing to the channel with the notification bell. Now, the stock market is selling off a little bit today. I'm down 1.67%. That is $5,869 as of right now. You cannot control where stocks trade in the short term. If I look at the one day, I'm down 1.7%. If I look at the past 5 days, I'm down 3.6%. That's $12,000, almost $13,000 in the past 5 days. It's a ton of money. Then I look at the past quarter, and it starts to even out. In the past 90 days, even with today's down day, I'm up $10,000. So this is how it works. Over time, the fundamentals will determine where a stock goes. In the short term, investor sentiment, emotions, fear, greed, all these type of things determine which direction a stock trades. The long term, it is the companies themselves, their profits and their earnings. So make sure to keep your emotions in check and focus on the long term. Now, this sell-off is not a picky one. It's broad across all the major indices, from the Dow Jones to the Russell 2000 to the NASDAQ to the S&P 500. It's all around 1.5% to 2%. That's basically where everything is selling off. And this is again mostly because we're getting really bad news with the Omicron variant. It's spreading pretty quickly. It looks like we're going to have another surge of another COVID variant. And this is weighing on investor sentiment. This, in combination with inflation, is making investors more bearish. Some countries are imposing restrictions to stem the spread of the Omicron variant as the holiday season starts. Israel said Monday that it would ban its citizens from traveling to the US or Canada. So now there's travel restrictions going on. Over the weekend, the Netherlands reimposed a lockdown, with all non-essential shops, bars, restaurants closed until mid-January. So countries are starting to turtle again and go back into lockdown mode, which of course is not good for the economies and is not good for stocks. President Biden plans to deliver an update Tuesday, that's tomorrow, to fight against COVID-19 in the US, where cases are rising. The rise in infections has prompted concerns that a new wave could prolong supply chain disruptions that have elevated inflation. So we might get more inflation, more disruptions, more lockdown. The Biden administration may be signaling a shift in their messaging around COVID. In a report from CNN, they say a shift towards focusing on severity instead of the case numbers. So far, everything with COVID has been focused on the number of cases, getting the cases down, because when Biden took office, he initially envisioned him getting rid of COVID. Well, the problem is the total number of new cases of any type of COVID doesn't seem like it might ever go away. It might be around forever. We had the initial strand, so this wasn't the variant. This was going away over time. Then came along the Delta variant, and that peaked. Then it started to trend downwards, and now we have the Omicron variant, and that's starting to peak as well. Maybe it will go down soon, but we don't know. It looks like this might be around for years. So it seems as though the Biden administration is now coming to the realization that this virus isn't going away as quickly as we wanted it to. They say some of Biden's advisors are encouraging the administration to begin discussing publicly how to live alongside a virus that shows no signs of disappearing. A potentially stark shift from messaging for a White House that was once touted freedom from the virus. So initially, Biden was coming in and he was going to crush the virus and get rid of it, right? He wasn't going to do lockdowns. He was going to shut down the virus. Now that messaging is needing to take a turn, and politically that's very difficult. Steering public attention away from the total number of infections and towards serious cases only, as some Biden advisors have encouraged, could prove a challenge after nearly 2 years of intense focus on the pandemic's every up and down. It is a part of a growing conundrum that Biden faces as the COVID-19 pandemic refuses to abate. Now, I think this is likely to happen. I think the White House and the administration will start focusing on the severity rather than the total number of cases, because it doesn't look like this is going away anytime really soon. It could be around for another year or so. And the whole time that's there, focusing on the total case number, it overshadows the efforts of the administration. I also think that the White House will be very hesitant to make any restrictive lockdown move that will slow down the economic recovery. If we have COVID around, the one thing that we do have right now is a recovering economy. If we slow down the economy as well, that's not going to look really well for the White House. So I really don't think that they have the political capital to really shut down the economy like they did previously. Now, in terms of what this means for our portfolios, of course, every stock across the board in most cases is going down right now. There's a few exceptions like Netflix and Vicer, but most of them are going down. My portfolio is down now more than $6,000 just today. But if I look at my actual companies, I have a good idea of which ones will actually be impacted by these events. In the tech category, we have two companies, Apple and Microsoft. Is Omicron going to affect Apple and Microsoft? Not really. Is inflation going to affect Apple and Microsoft? Not really. Is logistics and problems with shipping and manufacturing going to affect Apple and Microsoft? I don't think it will affect Microsoft that much, but logistics certainly affects Apple to some extent. They can't create quite as many devices and sell them if they're having some logistics issues. So I think this might have a very minimal effect on Apple. But with Microsoft, I really don't see any reasonable effect going on with Omicron, the variant, or anything like that. In the consumer category of companies, things get a little bit more dicey. The companies that I think will do just fine are Costco, Home Depot, Nike, and Target. Disney's one that's going to be heavily negatively impacted by more viruses spreading. We keep thinking that things are going to open back up for Disney, that they can grow their earnings, but these new viruses and shutting down movie theaters, shutting down their parks would heavily impact their earnings, which Disney is desperately trying to grow. So Disney's one of the companies I do believe will continue to trade down as long as we have concerns about Omicron. Now, the real estate category is one of the hardest hit categories during all of this. If I filter by the 1 day, we can see that we're down $1,500, 2.37% just today. And the companies across the board are selling off. VICI, Store Capital's moving down big time. Then we have Realty Income Corp, Simon Property, and of course MGM Growth Property, all in the red today. Now, there's a lot of factors that play into why these companies have been struggling today and over the past 6 months, but I'll show you a clip with Ed Petoniak later of I think the biggest factor of why these companies have been selling off so much over the past 6 months. Now, in the banking category, we also have JP Morgan that today is down 2.42%. Overall, I'm in the green by quite a large margin with this company. I've made some decent gains, but this is one of the companies that I've decided to not buy anymore. I've just been holding on to it because I've been concerned about the valuation. JP Morgan trades at a 1.8 price to book ratio. That's a very expensive financial holding, and unlike tech companies, I think banks have a more difficult time outgrowing their valuation. So with JP Morgan trading at such a premium, I decided to just hold on to this company, and it's been trading up and down since. Now moving on to my smaller holdings, we have in the restaurant category, Texas Roadhouse. And it makes sense why this company's in the red. If we think we're going to have lockdowns, restaurants are not the place to be. In my opinion, I think that investors are discounting Texas Roadhouse too much. They have an incredibly effective app and takeout system. They already have better earnings than they did prior to the pandemic, and they have a very solid balance sheet. So in my opinion, I don't have any concerns with this company. In healthcare, I have one company left. And that company is one of the smallest holdings in my portfolio. I only have $2,000 of value in it, and it's AbbVie. So far, this is a company that I'm just holding right now. I'll probably be exiting it sometime in the next couple of months. So this is not going to be a long-term holding for me. I've decided to move out of healthcare because it's not my strength. I don't feel like I can do great analysis on these companies. So even though I've made money with them, I'm moving this capital into higher conviction picks. So overall, when I look at my portfolio and I try to determine which companies will not be able to outlive the Omicron variant and different lockdowns and restrictions, I really come up with only a couple companies that I think will have a difficult time if these lockdowns happen and if COVID really continues on for years into the future. Both of them are based around in-person experiences. We have Disney. The only thing that's not really an in-person experience is their streaming service, but Disney is a massive company. You can't just invest in their streaming service. The other one is in the real estate category, which is VICI. Now, I've made VICI one of my biggest holdings in my portfolio. I started buying it around mid-2021. So mid this year, I started buying it around here, and I've been slowly dollar cost averaging into the company, lowering my cost basis. When I started buying it initially, it's down around 12%, maybe around 13%. So it's come down quite a bit, and this is what I asked Ed about in an interview. I asked Ed directly, why do you think the stock is selling off right now? It's trending downwards when on paper it's undervalued compared to its peers. And here was his response.
July of this year, we were tracking very well in terms of closing the valuation gap between ourselves and the leading triple net REITs.
Right.
When we were first born, we had a multiple gap of probably at least 4 turns. We were getting to the point where the only triple net REITs that had a meaningfully higher multiple than us were Realty Income, a great REIT. It's been around since 1969, and a very dynamic smaller REIT called Agri. What happened in the back half of 2021, which isn't over quite yet, obviously, is that with rising concerns around inflation and interest rates, the triple net sector as a whole began to go off the boil.
Yes.
It
that
went
is something
off
I was going to bring up. Yeah, for sure.
Yeah, the triple net REIT sector went off the boil. And what is unfortunate is to be part of a sector that goes off the boil when you, as an individual REIT within that sector, have issued a ton of equity into the market that year.
Yeah.
Because between the Venetian equity raise and the MGP equity raise, which we did in early September, Joseph, we put out $5.5 billion of incremental equity at a time when the market overall wants less triple net equity.
So Ed highlights 2 factors playing into VICI's price dropping over the past 6 months. One of them is inflation, which makes investors in general avoid the triple net lease REIT space. And VICI, of course, is in that space. But another factor for VICI is dilution. So this is kind of a double whammy. They have 2 things affecting their stock price right now. And he goes on to highlight how this really is not a huge concern for investors. He goes through each one of them.
The key thing to keep in mind is it's temporary dilution especially because when we issue equity, we generally issue it in the form of what are called forward shares.
Sure.
They actually don't count against our share count until we settle those shares.
Okay.
And take in the money at a time when we're about to close on an asset that will immediately start producing income. But that's a nuance that a lot of the market doesn't care about. They think, oh yeah, there's a whole bunch of new equity. They don't have the income yet. I think I'll just sit back and wait for them to close these big deals. And then I'll really start paying attention again because I'll know what the AFFO per share will be.
He points out that they don't actually dilute the shareholder until they're getting the income from the properties. But this is a nuance that investors don't pay attention to. I saw this in many of the Seeking Alpha comments. People saying, man, they're diluting shareholders like crazy. I want out of this stock, right? I don't want to buy into a stock that's doing dilution. But Ed knows that they're not really diluting shareholders because they're using the dilution for accretive deals. They're going to generate more AFFO per share than they were prior. So all this dilution is doing is making it so that your shares, each individual share, is generating more cash flow for you. Now I go on to ask him about inflation and the duration risk of VICI. Skipping around a bit, do you think with inflation being at like 9% or something, it's like up like crazy. And it seems like the Fed just announced they're raising interest rates. I know people you can kind of judge it in two ways. You can say it's a good thing you have long lease terms. They're like above 40 years, right? So you have these longer leases, and that's good because you have tenants, right? You want to have tenants for a long period of time. So as long as they stay in business, you basically have tenants for the next 40 years, which is really nice as a landlord. On the flip side, though, if you're thinking about these 40-year leases, and is there some duration risk there like you'd have kind of with bonds, with interest rates going up and with inflation going up? Is that the big concern there? How do you view that?
Yeah, so it is a real risk when your leases do not have any built-in contingencies around inflation.
Okay.
And you're right, inflation's high right now. The 9% number you're referring to, Joseph, I think is the producer price index number that came out earlier this week, which does not constitute consumer inflation per se. But consumer inflation, you're right, it's 6%.
Like 6%
it's high.
Or something? Yeah.
Yeah, it's high. And time will tell how transitory or not it is. We do somewhat uniquely as a triple net REIT, we do have a critical mass of our rent roll with leases that involve inflation protection for us as a landlord. So as an example, with Caesars, we have two leases. We have what we call our Las Vegas master lease and then our regional property master lease. Our Las Vegas master lease has what we call a CPI kicker, in that the rent escalates every year at a minimum of 2% or CPI.
Okay.
Right? And the higher of, I should say. So our rent on our Las Vegas master lease actually escalated nearly 5%.
Oh, wow.
As effective as of November 1st. Next year, our regional master lease will go to the higher of 1.5% or CPI uncapped. So if you take 40% of our rent roll, we have uncapped inflation protection built into the leases. That is very unique among triple net REITs. Only WP Carey among triple net REITs really has that kind of inflation protection in a meaningful part of its rent roll. Beyond that, we have another 20% of our leases that are the higher of either 1.25% to 2% or CPI up to a cap of 3%. But at least then, year after year, we're at least getting 3% escalation in our rent, which should, in most situations, keep us at least even, if not ahead of inflation. And then once we get to year 10 in our relationship with MGM, we will go to the higher of 2% or CPI up to a cap of 3%.
Okay.
What that all adds up to is we'll have a rent roll that's about 95% inflation protected. So relative to a lot of other REITs that tend to have either longer leases or, especially those with longer leases, we do offer a greater percentage of inflation protection.
Okay. So you're hedged against that a bit with the portfolio.
Yeah.
That's what I thought, because if you didn't think about this stuff beforehand, writing these agreements, you could get in a lot
too
of trouble.
late now.
Yeah, it's too late now.
Yeah.
Can't go back.
Yeah.
Investors in big institutions, generally speaking, when they see inflation, they become worried about duration risk. That is the length of an agreement where you have set pricing, because inflation can make that less valuable over time. But what Ed points out is another nuance that I think a lot of investors are not taking into account. Even though VICI has these incredibly long leases, they're above 40 years. So they basically have the tenants in there forever, for the next 40 plus years, but VICI is actually uniquely prepared to hedge against inflation because unlike most other REITs, VICI has CPI kickers. So I think VICI is actually one of the companies that's uniquely prepared to handle inflation above their competitors. Now, I'm not going to show the full interview here because it's an hour long, but you can watch the full interview for free on my second YouTube channel, Joseph Carlson After Hours. So search it there if you're interested. I think it's well worth the time. I think Ed is incredibly smart. He gives a lot of insights on REITs and how they work in general, and he has a very good understanding of the industry. So you might be able to learn something from listening to him. I certainly did. So even though VICI is one of the companies that's not been performing well over the past 6 months, it's down $3,300 or 13%. It doesn't change my sentiment on the company. I don't really care if investors are buying or selling it in the short term. I remain very bullish about this company. They're growing like crazy. They're buying up a lot of good properties. They have iconic, unique assets. They've collected 100% of rents, and I think they're really adequately hedged against inflation. I think it's a really good bet with a high cash flow company that has above a 5% starting dividend yield. So this has been one that I've been dollar cost averaging into as the price continues to fall. So with my portfolio firmly in the red today and the general market firmly in the red overall, it's not really a big concern for me. If you're a long-term investor, you're going to have days like today frequently. The stock market could go down another 10%, and that's something that you have to be mentally prepared for. Over time, I strongly believe the fundamentals will be the deciding factors of whether or not you make gains. Now, moving on, let's go ahead and venture into the fun territory of congressional members. In my opinion, Congress is a group of people that, generally speaking, don't create much. They're good at burning money, taxing other people, and complaining on Twitter about anybody that actually does anything. And Elizabeth Warren has become the prime candidate, the prime example of this type of behavior. Elizabeth Warren hasn't created thousands of jobs. She hasn't created any type of revolutionizing technology. I don't think she's pushed the world in a better direction. She spends most of her time online blasting different wealthy people that in most cases are good people. The first target that Elizabeth Warren really had a spat with is someone named Leon Cooperman. Now, Leon Cooperman is a billionaire. He's a successful investor. He's a philanthropist. He pays a tax rate of 55% of his income. So 6 months out of the year, he's working for the government. And the other 6 months, he's working for himself. He said openly that upon his death, the majority of his wealth will go to philanthropy. All of it will be given as donations to people in need. This is the boogeyman. This is the bad guy that Elizabeth Warren is going for. Now, Elizabeth Warren, despite any type of facts or objective evidence, still treated Leon Cooperman like the bad guy. In fact, she tried to summon him to Congress so that he could testify in front of Congress like he's some type of criminal for the crime of being very successful. Of course, Leon Cooperman denied that invitation and said there's no reason he needs to do that. So Elizabeth Warren moved on to her next target, which of course is Elon Musk. She said on Twitter, let's change the rigged tax code so that the person of the year will actually pay taxes and stop freeloading off of everyone else. And it has a photo of Elon Musk. Now, unlike a lot of other billionaires, Elon Musk is one of the unique ones that's really not shy on Twitter. He shares his opinion freely. He responded saying, and if you open your eyes for 2 seconds, you would realize I pay more in taxes than any American in history this year. And according to the Wall Street Journal, Elon Musk says that he will pay more than $11 billion in taxes this year, in 2021 alone. Now, Elon Musk didn't stop there. He also said stop projecting, and he shared a news article calling Elizabeth Warren a fraud about her lies of being Native American. And then he went on saying, you remind me of when I was a kid and my friend's angry mom would just randomly yell at everyone for no reason. Please don't call the manager on me, Senator Karen. Now, unfortunately, this story doesn't end there. Elizabeth Warren took this conversation and she decided that it would be a great fundraising opportunity. She's running ads on Facebook and Twitter that have her name, her profile picture there. It says sponsored and paid for by the Warren Democrats. It says Elon Musk is whining like a baby to his millions of Twitter followers. Again, Elizabeth Warren moves from billionaire to billionaire and she admonishes them like they're little children. She acts like she's the mom. And she's kind of admonishing her children, the billionaires. She says he must be scared because he knows what every other billionaire in America does, that he's been freeloading off of working people and that I won't back down from a fight. So she literally has this photo here calling Elon Musk with arrows pointed at Elon Musk's face. And one of them says, a freeloading billionaire. Now, I'm no Elon Musk worshiper. I know he's not perfect, and this isn't the Tesla channel. In fact, I don't even own Tesla stock right now. But calling Elon Musk a freeloader, really, Warren? That's the line that you're trying to sell Americans? That the guy that helped found PayPal, one of our most successful fintech companies ever, the guy that for the first time brought a car company, in fact, an EV company that's competing against the Europeans, competing against South Koreans and the Japanese and the Chinese. The first really competitive car company, and you're saying that he's a freeloader? The one that transitioned the whole world to EVs is a freeloader? The guy that this year is paying $11 billion in taxes is a freeloader? Really? That's the line that you're going with? Now, just to sprinkle in a little bit of irony and hypocrisy, Elizabeth Warren is also calling him a freeloader while asking for donations, saying she wants $10 from every average person to help Warren Democrats pass a new law. So to Elizabeth Warren, all this really is another fundraising opportunity to paint the billionaire as a bad guy, fundraise some money off of your constituents, and have that money run ads so that you can keep your seat in Congress and ensure your income line from the taxpayer. I don't think she actually views Elon Musk as a person that contributes to society. And in my simple estimation of who's actually contributed more and who's actually freeloaded more in our society, I think the decision's pretty simple. Now, Elizabeth Warren has been staying busy as of recently. She's also called upon the SEC to investigate security trades, so stock trading, by high-level Federal Reserve officials to determine if they may have violated insider trading rules. Now, I agree with Elizabeth Warren here. I think that Federal Reserve officials should not be trading individual securities, and they should have restrictions placed because they literally control the levers of how the economy works, and they have the tools to directly impact stock prices. If you have that type of impact, I don't think you should be trading in advance. And so Elizabeth Warren is calling on the SEC to investigate this, and she's also calling upon members of Congress to have trade restrictions imposed on them so they can't trade individual stocks. And this is where Elizabeth Warren butts heads with Nancy Pelosi. Congressional members go into privileged meetings where they see information that the rest of the public does not see, and then they do individual stock buys. Nancy Pelosi is one of the biggest offenders in this category. Her husband does a lot of stock trading, and some of it has very convenient timing with privileged information from Congress. When she was asked about this issue and whether or not she thinks that congressional members that have access to this information the rest of the public does not have, whether or not they should be able to trade individual securities, she's actually annoyed by the question. Listen to her response.
Because this is a free market and people, we're a free market economy. They should be able to participate in that.
Oh, we're a free market economy now. Interesting. She brings that up when she's rushing to her defense of why she should be able to trade individual stocks. But on other subjects, Nancy Pelosi is completely fine to come down with new regulations on businesses, on employers, on all sorts of different subjects. She's regulating this free market economy like crazy. But when it comes to regulating herself for making a lot of money with privileged information the rest of the public doesn't have, all of a sudden we're a free market economy. Sure, we're a free market economy, but Nancy Pelosi would be the first one to say that capitalism can't run without regulations. And even though we're a free market economy, isn't the goal of Congress to make it so that we all play on a level playing field? Isn't that the whole purpose of rules and restrictions, so that some people don't have advantages over others that are unfair? While I think that Nancy Pelosi is clearly on the wrong side of this argument, I wouldn't hold my breath to see any changes anytime soon, because Congress in general usually shies away from rules that make them make less money. Now that's all for this episode. I'll have more updates this week of which companies I'm buying, as well as fundamental research on a lot of different companies that I think you'll enjoy. So if you like this type of content and you want to see how this portfolio performs in the future, make sure to follow along for free. Other than that, I'll see you next time.